How much home can I buy? What's the max loan amount I can get? Ultimately, those are questions that relate to what's called your purchasing power. Like how much can I buy? What can I spend on a home? What can I afford? All those things come down to essentially just qualifying, right? Your purchasing power. Can you buy the $500,000 home or can you buy the $600,000 home? That's ultimately what you're trying to find out. And I would say the number one thing that ultimately drives that answer, and it's not the only thing, but it's the number one in my opinion, is what's called the debt to income ratio, the DTI, debt to income ratio. So what does that mean and what is it? So the debt to income says if you take your monthly debt obligations, which do by the way include the new mortgage you're about to get. So figure out what those the new mortgage payment plus your other monthly debts, and let's say those end up being 4 grand a month, right? So for all the debts, the mortgage, et cetera, is 4 grand a month. Then we figure out to take that total and divide it by your income. And this is pre-tax income. This is gross income. So it's not what's deposited into your bank account, it's what you actually get paid. So if somebody's a W-2 salaried employee and they make 120 grand in this example, that's 10 grand a month. So you would take the 4 grand a month for the new mortgage plus whatever debts they have at the time of closing, divide that by 10 grand a month, and their DTI is then 40%. So that number, that DTI, that 40%, that's going to be a huge, again, I think it's the primary driver for determining how much somebody can borrow. Now, understand there are other factors like your credit, the type of income, the type of property you're buying. There's all kinds of things that are going to also influence this number, but this is probably the number one driver. So that I can tell you that if you said, hey, my DTI is 28%, I'd say you're probably in pretty good shape. Assuming credit's good, you're going to be fine. If somebody says, hey, I got a 48% DTI, there's a real problem there. So what is it? And so that DTI helps lenders, again, just to do a quick look to say, okay, well, how much of their monthly income is going towards debts versus whatever's left over to pay other bills and life. So that's ultimately what it is in terms of what the DTI is. Now, truthfully, it can vary from loan program to loan program as far as what requirements are. So Fannie Mae, Freddie Mac, they require that you at least run the borrower's profile through their automated systems so that you can get it to where somebody with a 40% DTI may not get approved if their credit's not very good. You can get it to where somebody with a 45 can get approved because they got better credit. So the DTI as a whole for Fannie and Freddie, kind of the conforming loan amounts, typically is about 45-ish. I've seen, rare, but I've seen instances where they can go higher. And it depends on the time too. I've been doing this for over 2 decades. There were times back in the day where it can go way higher than that, in the 50s. Now, not so much. I'd say 45 is a good generic number. That's not an automatic. It doesn't mean if you have higher, you can't get approved. It's just saying that 45 is usually a pretty good cutoff. For government loans like FHA, VA, USDA, some of those have hard stops. Like USDA is going to say like, hey, if you got a 42 DTI, it's kind of their threshold is those are all lower when it becomes like manual underwrites. If the automated system will approve it, I've seen FHA, and again, it depends on the market. And like this is years ago, but I have seen FHA give something in the high 50s. I even saw one, I think a VA had a 62%. But again, that was many years ago, different time, different market, that can happen. Jumbo, those loans, so anything over the conforming loan limit, those are going to have harder, typically more firm DTI requirements like 43%, give or take. So again, every program is going to be a little different, but just know that kind of when you hit that 40s, the low 40s is kind of when you start being like, can or can't you? And that will ultimately help you determine your purchasing power. So that's the other thing too, is give us what you think the max is that you're going to be in terms of trying to finance and try to buy. Because once you know your max, just to stay at that threshold or below. What we sometimes see, unfortunately, folks say, I'm going to go buy a $500,000 home. And then they call us up, say, hey, I found one at 550. Again, that's not what we talked about. It doesn't mean you can't, but let's figure out where that threshold is from the beginning and work our way down. So again, the DTI can be influenced. They'll allow you to have a higher DTI with compensating factors, whether that's the type of job, the type of pay structure, good credit, more money in the bank, All those things absolutely are going to have an impact. And understand your DTI, guys, also needs to include like your mortgage insurance. Like when I say your proposed mortgage payment, it's going to include your property taxes, your insurance, your HOA, your mandatory HOAs, your mortgage insurance, things like that. So we do have a calculator. We'll put a link to it if you want to use it, where it's a loan amortization table. And all that word is a fancy way of saying is a mortgage payment calculator. But you can go in there and you can put in your loan terms. You can say I'm buying this loan with this much down at this rate. You can do all that. Then you enter your program, conventional versus FHA. I'm going to occupy it, put in any HOAs. And then ultimately, you go in there and start putting in the stuff like your liabilities. Here's how much I spent on a car. On my current house. Will be sold, not sold. Here's how much I spent on student loans, credit card debts, child support, alimony, things like that. You put all those debts in. You do not put in like the normal bills for everyday living, like we don't need your cell phone bill. If it doesn't show up on a credit report, we don't need it most of the time. Now, again, there are things, like I said, if like IRS lien or child support or something like that's not on a credit report, we still need those debt obligations, but they exclude the things that are more optional, air quotes, optional in life, right? But even though technically electric bill and water bill aren't optional, they still don't include those. So those are not part of those payments. So it's credit card bills, student loans, things like that. So if you have questions, give it your best guess, reach out to us. You can even send us the calculator you used. We'll take a look at it and run through that with you. But this is something we do for all of our loans, is we put that data in there so we can see the debt to income. So once you guys have that, you should hopefully be armed and dangerous. Again, it can vary by program, it can vary by individual, but certainly that at least helps you calculate your purchasing power when you're looking to get a home loan. And as always, you're welcome to reach out to us. We are here to help. And when you think mortgage, think Mark.